Is the very foundation of the American financial system about to be rocked by a crypto earthquake? In a stunning series of events that unfolded in the halls of power, the United States House of Representatives has just slammed the accelerator on cryptocurrency regulation, passing not one, not two, but three monumental bills that could redefine the future of money as we know it. This legislative whirlwind is happening just as former President Donald Trump prepares to potentially unleash cryptocurrencies into the retirement accounts of millions of Americans, a move his critics are calling a reckless gamble that could trigger another devastating financial crisis. This isn't just a news story, it's a high-stakes political drama with your financial future at its very core. Today, we are going to dissect this unprecedented legislative push piece by piece. We will unpack what the Clarity, Genius, and Anti-CBDC Acts actually mean for the market and for you. We'll explore the bombshell executive order that could see Bitcoin and other digital assets land in your 401k retirement plan sooner than you think. And finally, we will shine a light on the controversial legal mind, a man with deep ties to the crypto industry, whom Trump wants to install in one of the nation's most influential courts. So, are we witnessing the dawn of a new, decentralized financial era, or is Washington paving the way for a digital disaster? Let's dive in. The action kicked off in a dramatic session on a Thursday, a day that will likely be remembered as a massive legislative milestone in the U.S. digital asset landscape. After heated debates and politically charged delays, lawmakers pushed through a package of bills during what Republicans proudly declared their Crypto Week. The first to pass was the Digital Asset Market Clarity Act, or Clarity Act. It sailed through with a decisive vote of 294 to 134. What's truly remarkable here is the bipartisan nature of the support. Nearly 80 Democrats crossed the aisle to vote in favor, signaling a significant shift in the political calculus surrounding crypto. For years, the American crypto industry has been trapped in a regulatory nightmare, a tug-of-war between two powerful government agencies, the Securities and Exchange Commission, or SEC, and the Commodity Futures Trading Commission, the CFTC. The SEC, under its aggressive chairman, has argued that most cryptocurrencies are securities, like stocks, and should be regulated with an iron fist. The CFTC, on the other hand, views assets like Bitcoin as commodities, like gold or oil. This isn't just bureaucratic squabbling. This ambiguity has led to billion-dollar lawsuits, stifled innovation, and left businesses guessing which set of rules to follow. The Clarity Act aims to finally end this chaos by drawing a clear line in the sand, creating a pathway for digital assets to be classified as commodities, and providing the legal certainty the market has been begging for. Next up was the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or the Genius Act. This one passed with even stronger bipartisan backing, a staggering 308 to 122, with more than 100 Democrats lending their support. This legislation targets stablecoins, the digital tokens pegged to assets like the US dollar that serve as the bedrock of the entire crypto ecosystem. Think of them as the digital poker chips of the crypto casino. The need for this regulation became terrifyingly clear during the catastrophic collapse of Terra/Luna, a so-called algorithmic stablecoin that wasn't backed by real dollars. It imploded in a spectacular death spiral, vaporizing over $40 billion of investors' money in a matter of days and sending shockwaves through the entire market. The Genius Act aims to create a robust federal framework to prevent such a disaster from ever happening again, demanding that stablecoin issuers hold one-to-one reserves and operate with greater transparency. However, the spirit of bipartisanship came to a screeching halt with the third bill, the Anti-CBDC Surveillance State Act. This one scraped by on a razor-thin, almost purely partisan margin of 219 to 210. This bill represents the ideological heart of the entire debate. It aims to outright block the Federal Reserve from issuing a central bank digital currency, or CBDC. Supporters of the bill paint a chilling, dystopian picture of a future where a digital dollar could become the ultimate tool for government surveillance. They argue it would allow the state to monitor every single transaction you make, and potentially even program the money itself to restrict what you can buy or even make your savings expire if you don't spend them. The debate over this was so intense that it actually delayed the entire legislative process as a faction of Republicans demanded an even stronger, more explicit stance against what they see as a financial instrument straight out of an Orwellian nightmare. This debate is splitting Washington in two, and the battle lines are drawn with stark intensity. On one side, you have industry stakeholders celebrating a victory for American innovation. Summer Mersinger, a former CFTC commissioner and current CEO of the influential Blockchain Association, hailed the anti-CBDC measure as a vital defense of individual financial freedom and healthy market competition. In her view, this is about preserving the fundamental principles of privacy and economic liberty in the digital age. But on the other side of this ideological chasm, the opposition is fierce. Representative Maxine Waters of California organized a press conference she branded as Anti-Crypto Corruption Week. Her message was a grave warning. She condemned the bills as a dangerous rollback of essential financial protections that could weaken federal safeguards and invite the very kind of systemic risks that led to the 2008 global financial crisis. She paints a picture of a reckless industry being handed the keys to the kingdom, putting the entire economy at risk for the benefit of a few. So, who do you believe is protecting your interests? The innovators promising freedom, or the veteran politician warning of financial Armageddon? If you think it's high time for clear crypto rules in the US, hit that like button. Let's see the support for this monumental shift. While lawmakers clash on Capitol Hill, the White House is preparing a move that could bring this debate directly to your retirement account. President Donald Trump is reportedly on the verge of signing a sweeping executive order that would clear the path for American 401k retirement plans to invest in alternative assets, with cryptocurrencies as a key component. This order would direct Washington's regulatory agencies to explore how retirement plans can safely incorporate not just digital assets, but also precious metals and funds related to infrastructure and corporate buyouts. This represents a fundamental rethinking of retirement savings, moving beyond the traditional diet of stocks and bonds. This policy bombshell follows a significant regulatory shift from the U.S. Labor Department, which in May rescinded Biden-era restrictions that had severely limited crypto in 401k plans. The stage is being set for a massive influx of retirement capital into the digital asset space, and the numbers involved are simply staggering. The American 401k market is a behemoth, comprising over 715,000 plans, holding an astonishing $8.9 trillion in assets as of September 2024. Even a tiny 1% allocation from this colossal pool of money would mean nearly $90 billion flooding into crypto. This could forever alter the investment landscape for ordinary Americans, but it's a double-edged sword. On one hand, it could democratize access to high-growth assets. On the other, it introduces the infamous volatility of crypto into the sacred realm of retirement savings. Imagine watching the nest egg you've built for 30 years swing by 20% in a single weekend. The potential rewards are immense, but the risks are just as profound. This isn't just a theoretical future either. The private sector is already moving. In April, the financial services giant Fidelity, which manages $5.9 trillion in assets, launched its own crypto-enabled retirement account. The trend is global, with lawmakers in North Carolina and pension funds in the United Kingdom and Japan also exploring crypto allocations. If President Trump signs this executive order, it will be a historic development at the intersection of digital assets and the long-term financial security of millions. But new laws and executive orders are only as strong as the courts that uphold them, and this is where the strategy becomes crystal clear. In a move that sent shockwaves through legal circles, President Trump nominated Eric Tung, a corporate lawyer renowned for representing crypto giants, to serve as a judge on the Ninth Circuit Court of Appeals. This isn't just any judicial appointment. The Ninth Circuit is arguably the most influential court outside of the Supreme Court, presiding over appeals from 9 Western states, including the tech and crypto heartland of California. Tung's confirmation would place a figure with unparalleled, deep ties to the crypto industry in a position of immense judicial power. Currently a partner at the prestigious law firm Jones Day, Tung's legal resume is a testament to his role as a legal champion for crypto. He famously represented the Blockchain Association in its challenge against the Treasury's sanctions on Tornado Cash, a crypto mixer. He has also defended BitMEX and argued that stablecoin sales do not constitute securities offerings, a core legal battle against the SEC. Unsurprisingly, this nomination has drawn sharp criticism. The watchdog group Accountable.us immediately sounded the alarm, framing Tung as a pro-deregulation fox being put in charge of the henhouse. They warn that his extensive record suggests a strong bias towards dismantling the very regulations designed to protect consumers and the financial system. They see his appointment as the final piece of a broader pro-crypto agenda: install an ally who will consistently rule in favor of the industry. The story is far from over. We are witnessing a coordinated, three-pronged push: new legislation to create a friendly framework, a potential executive order to unlock trillions in retirement funds, and a strategic judicial appointment to defend it all. Is this a bold strategy to secure America's leadership in the digital age, or is it a high-stakes gamble with the nation's financial stability? The Senate is now the next battleground for two of these bills, while the Genius Act and the 401k executive order could be signed any day. The future of money is being decided now. We will be tracking every development. To make sure you don't miss our next deep dive, be sure to subscribe and hit that notification bell. You won't want to miss what happens next.